If this banking crisis, as I believe it will, accelerates, it could take out some bullion banks. And then there is no knowing what price on that basis gold will be. Don't assume it's one way, because the authorities, will probably lean on the gold price as much as possible in order to keep it under control.
This is Kaiser Johnson with Liberty in Finance, and this is the Miles Franklin Weekly Special for May 2nd through May 9th, 2023, while supplies last. In our first special in more than 6 weeks, we are excited to feature the 2023 Australian Silver Kangaroo at just $4.85 over spot. The 2023 Silver Kangaroo from Australia are renowned for their 4/9 fine purity as well as their recognizability and design. Like many other coins, they come 25 to a tube. However, unlike others, the Australian Monster Box is just 250 coins, making it the most affordable Monster Box available, especially with a premium of just $4.85 over spot per ounce. And finally, Silver Kangaroos are IRA eligible. And if you'd like to learn more about a precious metals IRA, an IRA holding assets in a private depository rather than a bank or brokerage, call us, and we'll be happy to help you in that process. To order this special or any of the many other options we have available, call us at 1-888-81-LIBERTY. That's 1-888-815-4237. We're available after hours and on weekends, and we look forward to speaking with you.
Hey everyone, this is Elijah K. Johnson with Liberty in Finance. And back with us today, one of our most popular guests, Alasdair Macleod, the head of research at goldmoney.com. Alasdair, thank you so much for joining us today.
That's very much my pleasure, Elijah.
Well, when we heard of the news with First Republic, it finally collapsing over the weekend, taken over mainly by JPMorgan, the FDIC paying roughly about $13 billion in losses there. I thought, we need to have you on. So thank you so much for taking the time here. Your perspective on this ongoing banking crisis with this new development with First Republic.
I think your use of the word ongoing is exactly right. The problem that's underlying this now is that credit is beginning to contract. And what this means is that the price of credit, if you like, interest rates, are being forced to rise further. The Fed actually have got virtually no control over the situation, nor has any of the other major central banks. We sort of think that central banks manage interest rates. Well, this one's run away from them. And actually, it's interesting, if you look at the history of interest rate cycles, going all the way back to the beginning of the 19th century, you see that interest rates move in accordance with the banking cycle. Now, what that means is there gets a point where the banks collectively have expanded their balance sheets to the point where they become more scared of risk than they are greedy for profits. And consequently, they try and rein in their liabilities, which basically means that they stop lending freely. And if anybody manages to borrow bank credit, it is at a higher interest rate. That is what drives interest rates. And it's not, the Fed sort of thinks it's in control of the interest rate, as indeed every other central bank, but they're not. This overrides everything that the central banks do. So why does this matter? Well, it matters because with rising interest rates and collapsing bank credit, you're going to get more bank failures. It's as simple as that. It's a completely different environment from the one that we had up until 2020 and particularly, I suppose, 2021, because interest rates have had to rise, driven initially, I suppose, by signs of inflation. There were mistakes made by government in this. The idea that you can cut off the major commodity and energy producer, exporter of energy and commodities, and just sanction them. and think there's no blowback on commodity prices and everything else. It's just absolutely crazy. And so, in a sense, the timing of this has been inflicted on us by government action, geopolitics, if you like. But there is absolutely no doubt that with rising interest rates, you get falling financial asset values. And guess what has happened over the last 40 years? I mean, basically, since Big Bang in London, banks have increasingly become involved in financial activities as opposed to their traditional providers of finance for industry, and they are exposed to collapsing, to the bubble, if you like, the equity bubble collapsing. And not only they are exposed, but they're complicit in doing it for very, very sensible reasons. So that's where we are, and this is why the idea that you're going to have 2 or 3 banks failing and then don't worry, it's all right. Forget it. That's not the case at all. I'm afraid this is only just the start of this problem.
Now, what we saw was that JPMorgan took over First Republic, essentially, JPMorgan being the biggest bank here in the U.S. We have a question here from Tim. With bank failures increasing, will big banks like JPMorgan be threatened, or will they come out bigger after merging with failed banks?
I think the first thing to appreciate is actually the relationship between the Fed and JPMorgan. As far as the Fed is concerned, its route into commercial banking is basically through JPMorgan, JPMorgan being now the biggest bank in America. And so it's entirely natural, as far as the authorities are concerned, that they should be working with JPMorgan to absorb these problems. And that, I think, is going to continue. I think the thing that's sad about it, in a sense, is that bank lending works best on a local level. I mean, if you go back, anyone sort of 50, 60 years old or more can remember smaller banks and remember that there were bank managers, and you would go in and you would meet the man who you were going to try and persuade to loan you money. And when you were loaned money, it was, you had to convince him on a business plan. And not only that, but you had to it wasn't, you weren't financing consumption, you were financing production, basically. And of course, all that's changed. These small banks have gone. You're now talking to a computer. You want to borrow some money from a bank, go and talk to its computer, and you've got to tick all the boxes. And if the answer is you can't tick all the boxes, then, you're rejected. I think it's very sad that has happened. And I think that regulation has taken banks in completely the wrong direction. And my point about regulation is that the regulators would far rather deal with a few large banks than have a plethora of small banks, which they see as injecting risk into the banking system. They don't understand business. They don't understand loan business. And consequently, they are, through their approach of making banks ever larger, they are actually destroying the ability of banks to provide a real public service in terms of creating credit for economic progress. And so, to my mind, they are going down completely the wrong route on this. But, the whole thing's falling apart. So we don't actually have a lot of choice. And as far as the authorities are concerned, they, I think, are now waking up to the fact that they cannot let any bank fail. The idea that you can take a view on moral hazard, forget it. You can't do that, because to do that would potentially create a domino effect. I mean, it is a primary duty of a modern central bank to guarantee the deposits of every depositor in the commercial banking system. That is what regulation is meant to do. Now, regulation fails abysmally, and we know that regulation can never work. You and I might know that, Elijah, but, unfortunately, the regulators believe in what they're doing. Really, I think this is going in completely the wrong direction, but there's nothing we can do about it. Yes, banks will, banks like JPMorgan will presumably continue to absorb smaller failing banks, and they will exact their pound of flesh from the Fed and the US Treasury and the FDIC in the process. Of course they will. Jamie Dimon's not an idiot. I mean, he's pretty smart at this one. Which brings me on to his comment. I mean, he was quoted as saying that this recent bank rescue, the banking system is now sound. Now, I mean, I don't think he believes that at all. But I mean, he was chewed off for saying, and this is way back earlier last year, was it April? There was a banking crisis conference in New York, when he said that he was increasing his view of the U.S. economy from it's facing a storm to it's facing a hurricane. The Fed didn't like that at all. And so JP Morgan's chief economist had to sort of claw back a bit and say, it's really not that bad. But we had the warning from the world's most powerful banker that he was going to contract his balance sheet. The only reason it's expanding now is because he is absorbing banks, which are failing in this credit environment.
Now, you mentioned how we don't really have any choice in the matter of what's going to happen. The Fed also, you mentioned, central banks don't really control interest rates at the end of the day. There's this whole debate about when will the Fed pivot and everything, but the rising of rates, it seems like you're saying, is inevitable, regardless of what central banks do. Can you expand on that?
Yeah, I think I sort of covered it. Just the easiest way to look at it is to assume that credit has a price. I mean, it's not as simple as that, because interest rates are actually, they're two functions, really. Well, I mean, the basic function of interest rates is a price for credit. Let's be clear on that. But it is it prices credit in an environment where depositors, and here we're referring particularly to foreign depositors, because they're the people who are most sensitive to this. Foreign depositors who look at the prospects for the purchasing power of a currency, we're talking about the dollar here, and think that there is no point in me as a foreigner holding dollars when all I can get on it is 4% when the purchasing power of the dollar is declining by 6% or whatever, 7%, and maybe going to be declining more. So you've got two issues here. There's what the foreigners think in terms of what they need, if you like, to retain dollars. And you've also got the contracting of credit, which is driving up the price of credit, if you like, or the interest that a borrower is prepared to pay. Why is a borrower prepared to pay it? Because he's in trouble himself. And of course, the banks know this. I mean, they have whole departments analyzing risk, and they can see the business models going awry. And on that basis, they become even more reluctant to lend. We've already seen the leverage in the financial markets drop very, very substantially. That's the Nasdaq's, margin accounts figures. I'm surprised it hasn't actually contracted more rapidly than that. There's more contraction to come. And of course, as far as the Fed is concerned, this is a real problem because they have an awful lot of debt to sell, government debt. And this is in a market where the foreigners are no longer buying it. Why? Because the interest rates are not high enough to justify holding dollars. So they're sellers of dollars on the margin. At the same time, government spending, in other words, government spending is increasing, but tax revenues are likely to drop. So, the deficit is widening. The amount of debt that needs to be funded. I mean, I'm dismissing this current debt ceiling thing because it always gets raised. I mean, we forget that. It's just a charade, really. But these are the problems that we're going to see, I think, in the coming months. So what's not to like about it? Well, there's nothing to like about it, I'm afraid. I've been expecting this for some time, as I'm sure your regular viewers will know. And I'm afraid it's now upon us.
Now, the FDIC has obviously been protecting all depositors instead of just, the cap of $250,000 per account here. David wants to know your thoughts on the FDIC press release just released yesterday, calling for a higher insurance limit or a higher guarantee limit on deposits for business transaction accounts. So your perspective on that, and also just it seems like they're not abiding by this $250,000 rule. It just, we're going to save everyone here.
I'm afraid it's a sign of the authorities in total confusion over the whole issue. I mean, one of the problems is that following the Lehman crisis, bail-in legislation was passed, which basically meant that the authorities would decide, irrespective of company law, the authorities would decide who gets bailed and who doesn't. And obviously, depositors, bondholders were, effectively told you can take a running jump. This is a very confusing situation for the regulators, and that sort of statement to me is just a sign of their confusion. The fact of the matter is, and they probably can't admit this, the fact of the matter is they've got to ensure that there is no failure whatsoever. So the whole of the rescue, the whole of the commercial banking system in America has got to be underwritten by the Fed and the Treasury. And what does that do to the quantity of currency in circulation? Well, it's bound to mean that it's going to increase very substantially.
Now, we have a few viewers' questions here regarding the UK banking system. If you could kind of answer that for us, how does the UK banking system look in comparison to what we're seeing in the US?
Well, similar, I think, is the answer. There is an interesting exception to this, and that is two of our largest banks, and these are global systemically important banks, are HSBC and Standard Chartered. These two banks earn the bulk of their earnings in the Far East, and particularly China, Hong Kong, China, Singapore. And that region is showing a markedly different outlook to us. I mean, we're mired in a financial crisis. They are expanding. We have cut them off. We have, we don't like the Russians and we don't like the Chinese. So, we have cut them out from our financial system, if you like. So they are actually, we can all fall over, but they can continue. So this is a fascinating situation for HSBC and Standard Chartered. But the other banks have exactly the same problems that the American banks are now exhibiting. So I don't think it'll be terribly long before we see some of the banks in London beginning to get into trouble. I mean, bear in mind also that most of the banks in London are actually subsidiaries of foreign banks. Silver Valley Bank had a subsidiary in the UK, and that was taken out by HSBC for £1, effectively on the instructions of the Bank of England. And so, we've got the same sort of thing. Don't think that we're a refuge from what's going on in America. We are not. And the other point I would make is that London is a financial centre. Therefore, in a financial crisis, London is very, very exposed.
We have a question here from another viewer about brokerage accounts, because those are separate often from banks, but also kind of tied into the banking system there. What are your thoughts on brokerage accounts? And also, in the midst of collapse, how do people invest in? Is there safety with respect to investing in gold miners, commodity ETFs, dividend-paying stocks? A lot of these instruments that are, in a sense, tied into the system.
Yeah. Is there safety anywhere? Well, when it comes to brokerage accounts or brokers' accounts, basically, unless a broker is a bank, has a banking license, then what it would do is it will have a client's account with a bank. So, the risk, if you like, is a banking risk rather than a broking risk in that sense. Now, that said, brokers do have a problem because their business model really depends on a continuing financial bubble. Their costs have risen compared with what they were. They are market makers, so they need to have capital for that operation. And I mean, there's been some comment on Schwab, for example. I mean, there was an article on the Mises website about the potential problems for Schwab. I mean, basically, I think broking in this environment is going to be very difficult. And what I would see is that brokers are going to lose clients. So there will be, I think, a contraction in the number of brokers. So that's I think, the most important point. As to how you escape this situation, well, I mean, the fact of the matter is that if you get rising interest rates, you get falling financial asset values. And so, in general, that is going to be the background against which any investor is going to struggle. Now, I don't give investment advice, but what I can do is sort of comment briefly on the understanding that I don't give investment advice. I would say that it would make sense to look at miners because the values measured in fiat currencies of commodities as a whole, along with gold, obviously, are likely to increase, not because there's going to be wonderful demand for copper or whatever, but because the purchasing power of the currencies is likely to be undermined by these financial developments. Now, that being the case, I think that the mining industry, and the one which is probably closest to me is obviously the gold mining sector and silver miners. I think it's right to say, and I'm not an expert on this, but this is just merely my observation. I think it's right to say that a lot of the weaker mining ventures have been weeded out, and the exploration companies that have survived have actually, I think, sorted themselves out. They don't go out and do expensive investor presentations in foreign cities and all the rest of it so much. I mean, that game is definitely over. So I just feel they're more realistic, if you like, the management of these mines. So that's something which is worth bearing in mind. There is also the possibility of going into inflation-linked bonds, government bonds. I would certainly look at replacing fixed interest bonds with inflation-linked bonds. But I'm actually quite cynical about governments sticking to paying a proper inflation-adjusted rate. I mean, it's not beyond them to fiddle with the figures. So I don't think that's if you like, a complete solution. But nonetheless, I think those two areas are probably, if you've got to remain in fiat, and let's face it, most of us do with any sort of capital, we think that way, then those are probably the two areas I would look at. Otherwise, my own personal view is just get the hell out of fiat currencies. Get out of credit. It is credit that is collapsing. Do you want to have credit? No, you don't want to have a part in credit. You want to get out of it. You want to hoard real money, which since Roman times has very definitely been gold, silver, and for very small denominations, copper. But principally, we're talking gold.
Now, mentioning precious metals, we're seeing quite a pop today in the price. This morning, we're seeing gold well above $2,000 an ounce, silver quite a bit above $25. Your perspective on the recent bounce we've seen, and also really since the beginning of this banking crisis, we have seen a huge rally in both the metals.
Yeah, well, I mean, I think they've been somewhat left behind. It's interesting. I think, the thing is obviously driven not by demand so much for physical metals, though it's in very short supply, as I understand it. I mean, everybody I talk to, trying to sell coins to the public, and when you look at what central banks are doing, when you look at the deliveries that are coming out of COMEX, I mean, it's quite remarkable. This is not meant to be a delivery market, yet tons disappear out of COMEX through deliveries every week. I think, in the very short term, you have got bullion banks who are short. They always take the short side. It's very rarely they go long. Just occasionally they go long in silver because that's an illiquid market, and they somehow manage to do so, but they're not long of that anymore. When it comes to gold, however, the gold contract, they are short and they're now being squeezed. And here we have banks failing. So just imagine that you're a swap, and most of the swaps are bullion bank traders, trading desks. So you're running a position. You probably net short something over $1 billion on your gold contracts on COMEX. So that's your position. Now, you're in a bank, your management, your treasury department are probably getting rather worried about overall balance sheet leverage. So they will be knocking on your door in your department and saying, how's it going, Elijah? I mean, any sign of closing those shorts? Well, the trouble is, Mr. Treasurer, that the price of gold keeps on going up and we can't catch it. Oh dear, oh dear, oh dear. You can see the dilemma that they've got themselves into. And this could actually, if this banking crisis, as I believe it will, accelerates, it could take out some bullion banks. And then there is no knowing what price on that basis gold will be. Don't assume it's one way, because the authorities, by that I mean Americans, Europeans, us Brits, will probably lean on the gold price as much as possible in order to keep it under control. And I think there was some evidence that might have been going on in the last few weeks. I can't say definitely, but I would not be surprised. So this is not necessarily just a one-way ticket, but I think what I would emphasize is that the reason to buy gold is not buying gold, it's just to get out of credit. So the price doesn't matter. You just got to get out of credit. Now, if that is correct, then the price could actually start moving very, very quickly as the banking system deteriorates. That, I think, is the immediate situation. Longer term, what we are looking at, I think, is the inflationary consequences on this credit of central banks trying, and their treasury departments, the government treasurers, trying to rescue the banking system, take on board all the losses that may be involved. And in the case of the dollar, absorb all that selling of foreigners. And foreigners, on the last count and on the US Treasury tick figures, they had over $7 billion in bank deposits. Sorry, $7 trillion. Let me get that right. The number of noughts are frightening. $7 trillion. And they have got a further $24 trillion invested in long-term securities, US treasuries, corporate bonds, and equities. So there's a potential tsunami of foreign selling about to hit the dollar. That's really actually what this banking crisis is likely to generate. So, my own personal view, my own personal strategy, if you like, in investment terms, is not to invest anymore, but just get the hell out of credit.
The one thing I did want to touch on more is the bullion banks going under. Can you expand on kind of what kind of new dynamics that would be in the precious metal markets? Because it seems like at least a lot of people speculate the precious metal markets are largely controlled by the bullion banks. So what kind of new dynamics would there be if those went under?
Well, you're right to say that the bullion market has been controlled by these banks, but there is likely to come a point where they lose that control. Now, whether it's this time or, on the next banking cycle, only time will tell. But I think that the dynamics behind the situation have really escalated against bullion bank short positions very substantially. What we don't know, of course, is what their position on the London forward market is, because that's not really made clear. My guess is that the large banks have probably covered themselves with some physical. But as to their net position, I would rather doubt that they are net long if you take into account their positions on the London bullion market. What we're talking about is a completely different market environment from the one in which these traders have grown up in. They've been dealing in the London forward market certainly since the 1980s, and they don't actually understand that it's the dollar going down, if you like, if you're pricing things in dollar, rather than gold going up. They just look at it as a sort of, if you like, a piece of paper in which priced in dollars. It's actually the wrong way. But anyway, they will discover that the hard way. And I think this, on this cycle, that's likely to happen. There is another aspect of this, Elijah, which we haven't mentioned so far, and that is, what action would Russia and China take to protect themselves from a collapse of the dollar? Well, I think the answer is quite simple. They can only do one thing, and that is reintroduce for themselves gold standards to secure the credit values in their own currencies. And that's a very important point. I think they realize this. There's a guy called Sergei Glaziev, who is one of the chief economic advisors to Putin and heads up a committee for the Eurasian Economic Union looking at devising a new trade currency. But he wrote an article in a Russian or a Moscow business paper, rather like the Moscow version of the Financial Times or the Wall Street Journal, if you like, called Vedomoski, on the 27th of December, which I could have written. He was, he understood completely the role of gold in protecting the value of credit. Now, so far, I would say that China in particular, Russia less so, has been very, very reluctant to contribute anything to the upset of the global financial system. They do not want to be blamed for bringing the house down. I think this is clear. The Russians, I think, care less about that issue. So, but there is going to come a point where these two hegemons, China and Russia, are going to have to protect themselves. And it's not just them. They've already warned. Putin himself at the last International Financial Forum in St. Petersburg, attended by 81 official delegations and a number of other unofficial delegations from around the world, government delegations, told them quite clearly. He said, why hold reserves in Western currencies, the unfriendlies, as he calls us, currencies, when they can cut you off at the knees? Why hold them when they're only, at that time, I think the Fed funds rate was something like 2.75% to 3%, the rate of inflation was about 6.5%, according to the CPI. Why hold them when it's going down like that as well? You're on a loser. And why store your gold at these, in the vaults in these countries, in the unfriendliest countries, when they can just steal it off you? Remember Venezuela. What happened? We are meant to respect property rights, but we fell in line with American, I think CIA as much as anything, demands that we did not repatriate any gold to Venezuela. So we came up with a trumped up story about how the Venezuelan government wasn't legitimate, therefore we were not returning the gold. I mean, come on, it's not our gold. Our behavior in this has been really terrible, but it's given Putin, if you like, the excuse, the reasoning to tell 81 official delegations and a number of unofficial government delegations, look, these unfriendlies are not your friends. They are going to rob you. Get out of it. So he's already primed this. So I think that we're sitting in a situation where, as this banking crisis develops, there's going to be an avalanche of selling, potentially, coming from 81 smaller nations, if you like, most of which have got dollars in their reserves. I mean, not only dollars in their reserves, but they own US treasuries and so on and so forth. So this is not good. It really is not.
Now, Robert is wanting to know about this very issue with Russia developing possibly a new reserve currency with the BRICS nations. Robert asks, if the BRICS nations come up with a gold-backed currency, does that mean the rest of the fiat world needs to back the rest of their currencies with gold, or can two types of currencies coexist simultaneously?
I like it. Right, how am I going to answer this one? Well, one thing is clear from the mood music coming out of Moscow, and that is that they will go on a gold standard. Whether they do it properly or not remains to be seen. But they will do what they think is necessary to secure the value of ruble credit and tie it to legal money, which is only gold. So that's going to happen. For us to do that, we have got hurdles. First of all, how much gold have we actually got? Actually, that's probably the last thing we should be considering. One of the main problems is that we have a central bank system which is driven by Keynesian economics. They even reject monetarism. Now, monetarism is insufficient as an explanation for for the relationship between money and credit. That is for sure. But so what we're talking about is a completely intellectual volte-face on monetary policy in the West. And the establishment, which is bound up by group thinking, I think is unable to handle this. So what it means is that things are going to deteriorate very, very substantially until, as a last resort, they will probably use currencies as a means of distributing gold. Now, what I mean by that is not necessarily saying, right, okay, for $100,000, you can swap it for an ounce of gold. I don't think that quite. But what I can see is they will try and peg the currencies to gold so that effectively, the currencies become a money substitute rather than pure credit. That is the end game that they have to get to. But I am extremely pessimistic about the intellectual capacity of the system to understand this and adopt it. So I think things will go considerably worse than they otherwise would, because, if we actually understood what we were doing, we wouldn't get into this mess in the first place. It's as simple as that.
And we have a last viewer's question. I think this will have to be the last one here, from Cletus. Question for Alasdair. All currencies today are fiat and are failing. Has it ever happened before that all currencies failed at the same time? And what can we expect to happen to citizens and governments when this does occur?
The answer to his first question is that it has never happened before. And the reason for that is that before 1971, gold was included in the global monetary system. it was having less and less and less of a role. And, we've got to go back to 1933 when Americans were told, submit your gold coins, your bullion and your gold certificates to the government. That was the first real attack on the link between credit and gold. So, that's that I think. So this is the first time it's happened. But if, on the other hand, you look at the hyperinflations, which actually I think is a misnomer, you really look at it not so much that prices are going up, but the purchasing power of credit is going down. Yep. It's always been credit, that's happened. And if you look at the long-term price stability of gold, it's really been quite remarkable. Since 1950, the price of WTI oil, measured in gold, has fallen by roughly 17%. That's all. It's never more than doubled. There was an exception when the price went negative. If you remember back in, I think it was April 2020. But all this volatility actually is not on the gold side. It's coming from this ridiculous, speculation in futures, all in dollars. That's really where the volatility is. But if you really want to price things, don't price it in fiat currencies, price it in gold. That's really what this is telling us. What was the second part of his question?
No, what will happen to citizens and governments if all fiat currencies fail simultaneously?
Well, I'm not sure that it'll be exactly simultaneous, but I think it will mean that the power of China and Russia and Asia will increase very substantially relative to us. We will decline. And that raises concerns because we have an America with its allies, which are absolutely determined to get in the way of this growth in Asia. And I would worry that this could lead to an escalation of military conflict. And I think we're already potentially seeing that in the Gulf, in the Persian Gulf, because the Fifth Fleet has been sent there. There's, I think, the USS Florida, which is a nuclear attack submarine, has been sent there. There is concern that it may be sent into the Gulf through the Straits of Hormuz. There are concerns that now that peace has been restored to the whole region. The peace has been restored because the Americans have left. We're out of it. Now, this, I think, it is potential. If I've got that bit right, then potentially the Americans want to escalate tensions again. And there is an obvious bogeyman there, and that's Iran. And there is the obvious excuse that intelligence tells the Americans that they're progressing further with their nuclear ambitions than previously thought. Right, we'll send in a few missiles. We'll try and destroy the plants. Now, they do that. They won't have the support of Saudi Arabia anymore. Saudi Arabia will become your enemy. So this is a very delicate situation. And I just hope that the deep states, if I can call it that, the deep states' behavior is modified for these current circumstances. I see no sign of it so far. I really don't. And particularly the increase in tensions in the Pacific doesn't, to my mind, augur well for that aspect of the future, if you like. You're going to have one industry which is going to grow, and that's the defense industry. And, apart from anything else, we're all running out of ammunition over Ukraine. That horrid phrase, it's a meat grinder. But it seems to describe that awful situation, what we're doing with Ukraine between us and Russia. That is terrible. But having run out of ammunition, we've got to make more. We've got to make more missiles and all the rest of it. So that's probably the only growth industry that I can see in the short term. The rest of it ain't looking good.
Well, I think we all pray that this doesn't end up in further military conflict. I think one of the things that you said, if I could maybe just ask one last question here about that it's not like all currencies are going to maybe collapse simultaneously, but there's going to be this increase in power in the East and a decrease in power in the West. I know a lot of people have talked about how there might not be like hyperinflation or anything dramatic like that. It's just going to be continued high inflation, and the US and the West will just become less and less relevant. Do you see that as a possible scenario, or do you see a more dramatic event where we see like actual hyperinflation, 50% inflation per month, which is the definition of hyperinflation? Your perspective on kind of like the rate at which things will collapse?
Yeah, well, I don't like the description that we face inflation. What we face is a falling purchasing power of credit, and I think that I need to drum that into everybody's minds. Then it becomes more understandable. There will come a point when domestic Americans, domestic Brits, domestic Europeans realize that it's not prices going up, but the purchasing power of their currencies going down. And when they realize that, they're doomed. I mean, that's the end of it. We're probably quite a long way from that. I mean, I find it very, very hard to convince pretty intelligent people that this sort of the whole of the inflation story is actually miscast, and it's a question of the purchasing power of credit being lost, going down. That's actually what it is. But I think people will realize that eventually. So as to how rapidly it might happen, it could happen very quickly. I mean, when we had effectively paper currencies, looking at Germany in 1923, they reckon that final phase when people in Germany finally realized that it wasn't prices going up, it was their currency going down. So they just dumped the currency as rapidly as you can. As soon as you're paid your salary, get rid of it. That period was around about 6 or 7 months. We can go back to John Law in 1720 France. The period then when his livre became completely worthless was a similar amount of time. And in France again, if we look at the time of the assignats, some 60 years later, 70 years later, the time of the French Revolution, that again was sort of, 6 months, something like that. But now we have, this is my bank. I can go tap, 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 tap and move money. So it could be a lot more quick. I don't know that it's going to be like that. I doubt it, because what you've got to get into people's heads is this bit about prices. It's not prices going up, it's the currency going down. And it's a very, very stubborn belief that that is not the case. To dislodge that, I think you've got to see a period of decline in the purchasing power of the currency to the point where a wider public become convinced that that is the case.
It is a language issue as well, because, even I'm using the word inflation, which really it's currency devaluation. Maybe we should start using that instead. Inflation seems like things are going up, but really it's just the currency going down here. Alasdair, we really appreciate your time today. Before we let you go, if our viewers are interested in learning more about your work, they can see the description of this video here. We'll put a direct link to your articles. Can you share with our viewers your work that you do, and also any last thoughts you had?
Yeah, I write for Gold Money, as I'm sure your viewers know, and the article comes out on Thursday. The article that I'm drafting at the moment is about the legal position of money and the consequences of ignoring it. And the situation is absolutely clear. And I think a lot of the points in my article have actually been brought out in this interview. So it'd be well worthwhile, I think, viewers who are interested in looking at this subject further, logging on to Gold Money, hit the research tab, and look for that article. And it will be out, I should think, mid-morning, maybe early afternoon, Thursday, Eastern Standard Time.
Alasdair, thank you so much for your insights today, and God bless.
Thank you very much, Elijah.
Miles Franklin Precious Metals is one of America's oldest and most trusted bullion dealers. Miles Franklin is A+ rated and accredited by the Better Business Bureau, licensed and bonded, and has 0 complaints ever registered. Here at Liberty and Finance, we are licensed brokers with Miles Franklin. To order, simply call us, discuss your needs, and we can let you know our live inventory, prices, and availability, and lock in your order over the phone. Once your order is locked, the price is held for you regardless of market fluctuations, and the metals are reserved for you awaiting your settled payment. Within 1 business day of ordering, you will receive an email invoice detailing the order and payment instructions. Miles Franklin accepts payments by bank wire, ACH or electronic check, money order, check mailed priority mail, and cryptocurrency. The fastest forms of payment are bank wire and cryptocurrency. Upon settled payment, metals will ship out within 3 to 5 business days. You will receive tracking information via email. Domestic shipping charges are $15 for any order under 500 ounces of silver or 10 ounces of gold. For orders larger than that, domestic shipping is free. The package will be boxed, fully insured, and labeled discreetly, with no indication of the contents inside. For your privacy, the name Miles Franklin will not even be on the package. To talk to myself, Kaiser, my brother Elijah, or my father Dunnigan, call 1-888-81-LIBERTY. That's 1-888-815-4237.